How do you buy Chinese equity? There are many different funds to choose from, and the selection just got broader because China's opened up its capital markets, and now you can buy Chinese domestic stocks which trade on their domestic stock exchanges. But there are many different funds to choose from, and the stocks themselves are complicated with many different confusing names. So let's look at that in a bit more detail. This is not a recommendation. If you want advice tailored to your specific circumstances, seek independent financial advice. This video stemmed out of a question that was asked on our Slack channel in PensionCraft. One of our members found the Franklin Templeton FTSE China ETF, which has an ongoing charge of 0.19% per year, and they were wondering whether there's a catch. So we'll come back to Franklin Templeton at the end of the video. Remember that if you want to ask your own questions at any time, you can always join us for $5 a month. And if you want to speak to me one-to-one, you can join at the $25 a month tier. The reason why there's more interest in China is that it's making up more of global growth. If we think in terms of purchasing power, then China overtook the United States in 2014. And it won't be too long before its normal GDP measure takes over the US as well. The reason why GDP matters is that it sets a sustainable level of growth. If GDP in China is bouncing around at around 6% versus the 3% for the United States, then in theory its corporate earnings could grow at that 6% level for a long period of time without coming to dominate the Chinese economy. This is mitigated to some extent because corporates have global earnings. So some US companies could earn their money in emerging markets. But for domestic companies, GDP growth really matters. And if we look at the capitalization or the size of the stock market of domestic companies as a percentage of GDP, and this is one of the valuation measures which Warren Buffett looks at, you can see that in the US it's at about 150%, whereas in China it was only at 50% in 2018. Now GDP is not something in which you can invest directly. You can only invest in equity markets. The black line shows the performance of the CSI 300 index, which we'll see more details about later on. But these are the largest Chinese domestic stocks. And you can see that their performance has been very good relative to both the S&P 500, which is in blue, and the whole of emerging markets, which also includes China, in red. But you can also see that it's been an extremely rough ride, with incredible rallies, but also some very spectacular falls. So at the outset, you should be aware that this will be a very risky ride. China's an emerging market, and that means you'll be taking risks which you just don't get in developed markets. The reason why the domestic market in China is particularly interesting is precisely because it's exposed to that domestic GDP growth. And that's why the CSI 300 has had such great returns since 2005. The S&P 500, in contrast, has a much lower volatility of below 20% over that period, but its return has also been much lower. But what's also interesting is that the domestic stocks in the CSI 300 have performed better than the iShares China Large Cap ETF. And that's despite the fact that the risk of the CSI 300 was slightly smaller than it was for the large caps. The increased interest in China A shares is reflected in the increased weight that they have in MSCI's Emerging Markets Index. In 2019, the weight of A shares increased significantly, and this happened in three phases. In April, A shares increased to 1.8%, in July to 2.5%, and by the end of 2019, they'd increased to over 4% as a proportion of MSCI's Emerging Markets Index. And there are a number of reasons why China's looking attractive. Emerging markets tend to do well when the Fed has low interest rates. And after a period of quantitative tightening since 2016, in 2019 the Fed reversed course and started to cut rates again, as there was deterioration in the global economy, which the Fed thought may have impacts on the United States. And this is the size of the US central bank's balance sheet, which exploded due to quantitative easing to over $4.4 trillion in 2015. It stayed there for a while and then started to shrink with quantitative tightening, but then when there was a hiccup in the repo markets recently in 2019, it started to expand again. And this is certainly a tailwind for emerging markets generally. The trade war's been problematic for China, and it's certainly impacted certain Chinese sectors which depend on exports. But on the whole, the Chinese economy has held up fairly well, given the scale of the tariffs which have been imposed by President Trump. And now that there's starting to be a negative impact in the US, it's much more likely that they will reach some kind of agreement which will reduce the size of the tariffs. And it's notable that President Xi is president for life, whereas President Trump has at most one more term in office. So China can afford to play the waiting game as long as they can continue to grow despite the fairly punitive tariffs. If you watch my channel regularly, you'll be used to this map of global valuations based on Shiller's CAPE ratio. So countries in red are expensive, whereas countries in blue are cheaper. And despite interest in China, it comes out fairly well on this CAPE measure. It's currently at a CAPE ratio of about 14.5 versus 29 in the United States. And some of that value almost certainly stems from the impact of the trade war. So for long-term investors who can look through that noise, it may be a good time to buy Chinese equity. But as always, remember, this is not a recommendation. And China is certainly a very risky equity market, so tread with caution. Now let's look at the domestic stock exchanges which trade Chinese equity. The two domestic stock exchanges are in Shanghai, and that's the fourth largest stock exchange globally as of 2018, with a market cap of just over $4 trillion. And the second market, which is smaller but growing rapidly, is the Shenzhen Stock Exchange, but you can see that these are still a long way behind the US, which has a combined market cap of about $33 trillion in 2018. Both of those markets are on the east coast of China, about 1,400 kilometers apart, with Shanghai in the northeast coast and Shenzhen very close to Hong Kong on the southeast coast. Now let's look at the types of Chinese stock. Those domestic stocks which everyone's trying to get their hands on are called A shares. They're traded on the Shanghai and Shenzhen stock exchanges, and they're priced in the domestic currency, which is the renminbi or the yuan. Previously, foreign investors could only buy B shares, which are also traded on the same exchanges, but they'd be priced in foreign currencies. Another choice is H shares. These are the shares of companies incorporated in mainland China, but which trade on the Hong Kong Stock Exchange in Hong Kong dollars. Then there's a play on the word blue chips, which are large US companies, and the Chinese version was red chips. These were state-owned enterprises from mainland China which traded on the Hong Kong Stock Exchange, again in Hong Kong dollars. Then there are P chips which trade in Hong Kong, but these are private companies, usually incorporated in the Cayman Islands, Bermuda, and the British Virgin Islands. FTSE Russell has a nice classification table for these different types of share. The two which I didn't mention are N shares, which trade on Nasdaq or the NYSE market in the United States, and which are companies controlled by mainland Chinese entities, and which derive the majority of their revenue from the People's Republic of China. And finally, S chips, which trade in Singapore, but which are companies controlled by mainland Chinese entities, and these trade in Singapore dollars. The reason why investing in China is problematic is because of its capital controls. The US website export.gov has this article explaining what that means for companies that deal with China. The People's Bank of China and the State Administration of Foreign Exchange, or SAFE, maintain a very strict control of money that moves into or out of China. And they also maintain a managed float system, and that means that the Chinese yuan or renminbi trades within a very tight band, which is controlled by China at all times. There was a further tightening of the rules at the end of 2016 with the aim of targeting money laundering, terrorism financing, and fake outbound investment transactions. But one of the other goals of this tightening was to impose very strict control over their currency, which was weakening at the time, and that was a result of outflows from China. This is the value of the Chinese yuan since 2008, expressed in US dollars. And when this line rises, it means the yuan is weakening versus the dollar. And this is a fairly rapid weakening, which you can see in 2016. To place it in context, here's the same graph of the Chinese yuan, but I've also included sterling versus the US dollar, and that's shown in red. Notice how this freely floating currency pair is much more volatile. and it's also subject to rapid changes, as happened after the EU referendum in 2016, which caused sterling to devalue versus the dollar very dramatically. China imposes these capital controls to avoid a replay of scenarios like the Asian financial crisis, and that caused a rapid devaluation of many currencies in Asia as investors pulled out their money. Capital controls stopped that from happening, but the drawback is that it's much harder to invest in China. But there are signs that China is trying to get more inward investment by weakening those controls for investors. So for example, in September 2019, SAFE scrapped the overall ceiling of 300 billion on total asset purchases, which it imposes on some investment banks and brokers. And these are called Qualified Foreign Institutional Investors, or QFIIs. And SAFE said that this was to greatly enhance the convenience of participating in China's onshore market for foreign investors. And it's important to understand some of the financial plumbing that goes on behind the scenes, namely Stock Connect. This is a collaboration between Hong Kong, Shanghai, and Shenzhen stock exchanges, which allows international investors and mainland Chinese investors to trade securities in each other's markets. If you look at the Hong Kong Exchange website, you can look at the individual flows going north to China and coming south to Hong Kong on a daily basis, and you can see how large that balance was as a percentage of the daily quota. Despite the existence of Stock Connect, there's clearly a bottleneck for investors, which for some reason reminds me of an octopus trying to squeeze through a very small hole. If you haven't seen this video, you should certainly take a look. But what's clear is that Stock Connect is becoming more popular as more money flows through the very narrow hole. The foreign net purchases of Chinese equities reached about 200 billion renminbi in 2019. But it's certainly a move in the right direction, and in a statement, MSCI welcomed the progress of Chinese authorities in their effort to make Chinese A shares more accessible to foreign investors. However, they note that it would be useful if China had index futures and other derivatives on onshore and offshore exchanges. The reason for that is that market makers need somewhere to lay off their risk, and the futures market is a very efficient and cheap way to do that. It's a critical part of risk management tools which brokers use, but developments such as these will probably come in time. Now let's look at the Chinese equity indices, because passive funds will track those indices. MSCI China contains large and mid-cap representation, which includes H shares which trade in Hong Kong, B shares which trade in foreign currency in the two Chinese exchanges, but also red chips, P chips, and foreign listings, which might include ADRs held on the New York Stock Exchange. This contains 500 stocks, which covers about 85% of the Chinese equity universe. And as we saw, it also now contains large cap A shares. And as we've already seen, the performance of that MSCI China index is better than emerging markets overall since 2005, and considerably better than the MSCI ACWI index, which contains all global equity. It stands for All Country World Index. The Chinese equivalent of the S&P 500 is the CSI 300, and that contains the 300 largest and most liquid A-share stocks. Remember, these are the domestic Chinese stocks which trade on the domestic Chinese exchanges, and they trade in the domestic currency. Looking at the sector breakdown, you can see that it's hugely dominated by financials here in green. The huge insurance company Ping An makes up 7.3% of the index alone. And FTSE Russell also has its own suite of Chinese indices, the most famous of which is probably the FTSE China 50 index, which contains 50 of the largest and most liquid Chinese stocks, including H shares, red chips, and P chips, which are all traded on the Hong Kong Stock Exchange. There are also sub-indices below the top-level MSCI index. For example, MSCI China A contains only Chinese A shares which are available through Stock Connect, and it includes some mid-cap stocks, which will be even more exposed to Chinese GDP. And similarly, FTSE Russell has sub-indices which look at particular subsets of the Chinese stock universe, such as those A shares which are available through Stock Connect. Let's take a look at the funds which track those indices. This is a list of some of the largest funds, and I've sorted them by the ongoing charge, with the cheapest ones at the top and the most expensive ones at the bottom. And because this is an emerging market, the liquidity imposes a fairly high ongoing charge, with the cheapest funds at around 0.3%. These all trade on the London Stock Exchange, but they're not all denominated in sterling. Some of them are in US dollars. So be aware of that currency risk if you do invest in these. And if you want to find out more about them, just Google the ISIN code, which uniquely identifies each of the funds. Now let's come back to that Franklin Templeton fund, which inspired this video in the first place. As that sharp-eyed pension crafter pointed out, the ongoing charges for this fund are just 0.19%. It's a physical fund, which means that it buys the individual stocks which form part of the index it's tracking, which is the FTSE China 30 18 capped index. And it's optimized, which means it won't buy all of the stocks in the fund. It'll concentrate on the most liquid stocks in order to reduce the cost of trading. And that's passed on to you as a lower ongoing charges figure. The index which it's tracking is intended to stop there being too much concentration in any one stock. The constituents are weighted by the size of the company, the free float, and to avoid concentration in any single stock, the largest stock's weight can't exceed 30%, and any remaining company mustn't exceed 18%. But you can see that the largest holding, which is Alibaba, is well below the 30%. It's only 13%. But it's reassuring that there's not too much concentration risk. Some of those funds were issued quite recently, and because that Franklin Templeton fund was issued in 2019, there's not enough history to display it on this risk-return plot, which is based on daily returns since October 2018. So that's about a year of returns. For context, I've shown the Life Strategy funds over this period, which go from Life Strategy 20 up to Life Strategy 100. And I've also shown the S&P 500 and iShares MSCI Emerging Markets. What you can see here is that the index which you track is critically important in determining the risk and the return. The risk of all these Chinese stocks is well to the right of the chart, which means they're high risk. And unfortunately, some of them are also fairly low return, lower than emerging markets generally over this period, but also lower than these diversified global portfolios. Generally, the best performance has come from these China A-shares trackers, which tend to cluster with the CSI 300 index. But notice that this cluster is also further to the right of the graph, and that means they come with a higher risk. So I think you'll agree that the index which you choose is really important, and it's worthwhile spending a bit of time understanding the different indices and the risks that come with each one. A-shares have done well recently, but that might not always be true in future. Now remember, this came off the back of one of the Slack comments, and if you want to be involved in it, it's very easy. Just click on the button above to become a Patreon subscriber, and for that $5 which you'll pay, you get membership of our Slack community. You could ask one of those questions about China or anything else, and you get to join our Sunday evening calls and access to all of the previous Sunday evening calls too. That's a great value for $5. And as always, thank you for listening.